What happens after a bank sends a wire, processes a check, or moves money through the Federal Reserve? That behind-the-scenes rulebook is called Regulation J. Welcome back to J Get It. Today we're breaking down Regulation J, the Federal Reserve regulation that governs how Federal Reserve banks handle check collection, return checks, Fedwire fund transfers, and FedNow payments. Most people see money move and assume it just happens automatically. But behind every transfer is a legal system that determines who sent the payment, who receives it, when settlement happens, and who is responsible if something goes wrong. Regulation J is essentially the operating framework for certain Federal Reserve payment systems. It covers three major areas. First, check collection and returned checks. This governs how Federal Reserve banks collect checks, process them, return unpaid items, and settle balances between banks. Second, Fedwire Funds Service. Fedwire is used for large-dollar, real-time bank-to-bank transfers, and Regulation J defines how those payment orders are processed. Third, FedNow service. FedNow allows instant payments, and Regulation J provides the legal framework for how participating financial institutions send and receive those transfers. Here's the simple version. When a bank uses the Federal Reserve to move money or process eligible payment items, Regulation J establishes the rules. It determines who can send transactions, how reserve banks process them, when settlement becomes final, and what legal responsibilities each party carries. For checks, the Federal Reserve helps collect and process items between institutions. For Fedwire, the Federal Reserve handles large value payment transfers. For FedNow, the Federal Reserve supports instant payments in real time. Let's look at an example. Bank A sends a Fedwire payment to Bank B. Bank A submits the payment order. The Federal Reserve processes the transaction. Bank A's reserve account is debited. Bank B's reserve account is credited. The funds are transferred. Regulation J helps define the legal process behind every step. Why does this matter? Because payment systems are not just about moving money. They are about moving money accurately, securely, and with legal clarity. Without Regulation J, there would be inconsistent standards, more disputes, slower settlements, and greater operational risk. One common mistake is confusing Regulation J with Regulation E. Regulation E focuses on consumer electronic payments like debit cards and ATM transactions. Regulation J focuses on Federal Reserve payment operations involving banks and financial institutions. This distinction matters, especially for banking professionals. The real risk in payments is not simply whether money moves. It's whether the transfer is final, properly authorized, legally enforceable, and operationally secure. That's why Regulation J is so important. For banking professionals, the key takeaway is this: Regulation J is not a customer-facing rule. It is a banking operations and payment systems regulation that supports how financial institutions interact with Federal Reserve services. So remember, Regulation J governs Federal Reserve Bank check collection. It covers returned checks and settlement responsibilities. It governs Fedwire fund transfers. It supports FedNow instant payment services. And it creates the legal structure for secure and reliable Federal Reserve payment systems. If you're serious about banking, compliance, or financial operations, understanding Regulation J gives you a stronger foundation in how the U.S. payment system really works. Subscribe to J Get It for more banking and financial education made simple.